All right, good morning, everybody. So we got some jobless claims, continuing claims. Bank of England just hiked by 50 points. Some capital good revisions, and then we have additional auctions today. So keep your eye on things coming out of Europe. They've got a press conference later in the morning with Christine Lagarde. And then another one at 12:30, well, at 1:30 this afternoon. We've got some significant divergence between the Dow and the S&P NASDAQ. So here's the Dow from yesterday. We're looking at a daily chart. This is yesterday's FOMC movement. You can see how we closed red on the day. We closed inside the previous day's candle. And this morning we're down not a lot, more than 0.25%. The Dow Jones is a representation of your mega market cap, blue chip stock companies. And if you look at the names that are inside of it, a lot of them have been doing really good. It has been a safe haven through this bearish market to some degree. Flip that over and take a look at, the way that the S&P closed yesterday. In the upper portion, held the upper range, it set a low in the Globex around 10 o'clock and really never revisited it. Bring it out to the daily, look at how we closed yesterday. Very much extended in an inside day breakout from beyond the previous day's range. So looking at that versus looking at the Dow, is a significant difference. Bring in the NASDAQ, same thing. Great expansion candle yesterday, just a massive explosion, and not down at all this morning. Up more than nearly 1.5%. All right, so we've got a very large divergence going on in the marketplace right now. The MOC yesterday was a real surprise to me. I've mentioned this now for a couple of days. I don't bring it up often, but I look at this place every day when the numbers come out. I get these numbers. You don't need an account to see these numbers. You could just go to the website. You can see I'm not logged in. You go to stocks, scroll down to stock order imbalance. And it's just this little box right here. Now you can go through and look at the names that are in it and how big the buy or the sell size was on a free account. And you can go back over the last 5 days without having to pay for a subscription to this place. Before the FOMC, the buy side was 465. The sell side was really light at 129. Wasn't much of a surprise, I guess. It was a little big. I considered that to be a little big when we hadn't yet had the FOMC. We were waiting on it. And why would they make such decisions when we hadn't yet gotten any information. So after we did get the information yesterday, the expectation was, okay, we've got our decision, we got our information, decisions should be made. Where'd everybody go? There's no participation here. So there's a real surprise at how light it was. And I mentioned yesterday morning that we need to give the nerds a little bit of time to crunch the numbers, crunch the data, to really parse through what Powell had said, so that we can make a more informed decision about how we want to approach the next month. So we do have another FOMC meeting in March. So we've got March, May, June, July, and September. Now, Powell said yesterday that they are going to stay the course to their current target rate, somewhere above 5.25 perhaps, and that they're not going to deviate from that. We're at 4.5 now. March gets us 4.75. May gets us to 5. June gets us to 5.25. That's 3 back-to-back 25 basis point rate hikes. And that sets us up for July or September for the pause. And it would just be a pause. We're not talking about cutting rates or anything like that. We're just talking about the Fed no longer raising rates by that default 25 basis point rate hikes. Now, they said that 5.25 was going to be their kind of mythical target for the moment. Between now and March, or between March and May, we're going to be looking for them to maybe dial that back a little bit and only go for 5 as the target rate. That would be a 25 basis point rate hike in March, and then in May with a pivot in June. Either way it goes, what was really brought up yesterday is at some point in 2023, we're going to get to this mythical target rate. And that once we get there, they want to hold it there and then see if that's enough or not. Kind of look at the data for a while. The expectation is if we get to that point and we then are just holding the line at that elevated rate, that the longer the Fed does that, the more it will impact this soft landing concept. And that if they stay there too long, it won't be just a mild recession. It will be, a significant recession. It's too far down the road. Everything so far points to the idea that we're not going to be crashing and burning anytime soon. That he said that they were very close to where they want to be, and that once they get there, they're just going to hold. So with that in mind, when we come out and we look at what's going on in the S&P and in the NASDAQ and this capital rotation that we're seeing, it looks like we're going to be going back to tech and continue to see energy sell off. Now, tech, there's more tech than just those 9 mega market cap tech companies. And if you can see past those and start looking at some of the other names in the tech space, you'll see they're not doing too bad. It's really just those mega market cap names. And that kind of ties us right back in with the Dow Jones and the names that are in the Jones that might be a part of this beatdown that we were seeing yesterday. So Apple's got earnings, we got to avoid that one, but Microsoft already reported and it closed higher. CRM higher. Intel, go ahead, it's just beat down. Visa, Home Depot, right? We just kind of go down through the list. JP Morgan one of the financials closed down on the day, considering where it had closed the day before, but it had a nice rally back up, right? It's a hollow red candle, so it shows that it closed up here instead of down here. Goldman Sachs, same thing, rallied back up. Boeing had a nice little recovery. So, kind of flipping through these names, where's the down, right? AMGN, that's not a big enough company to take the Dow down. Travelers, same thing. It's not big enough to take down the Dow. Now, Caterpillar, someone else pointed this out. I didn't catch this. Caterpillar came out on earnings and said 2023 is going to be a great year, way better than 2022. We're going to do awesome, and the market sold it. I guess they didn't believe them. So energy down, and McDonald's was down, is down. A little bit of healthcare. And those were the names that were doing good last year, energy and healthcare. So when you're flipping through the Dow, trying to figure out why is the Dow down so far? Why did it close so horribly yesterday as opposed to the NASDAQ and the S&P? Energy and healthcare are the dominant spaces in there that took a beating yesterday. It doesn't necessarily bode well, right? Take a look at the Russell. Impressive. Small caps. Now, small caps were the first ones to take the beat down when things started to change, right? Back in late 2021, maybe mid to 2021 into the later part of the year. Started with small caps, micro, small, medium, large, and then mega. And it went in that order. Bubbles pop, right, up the chain. So it kind of makes sense that these smaller companies that had already bottomed, based, and started working their way back around again are doing good. It just was real shocking divergence, and I wanted to make sure that we got it covered this morning, pointed it out, had a little discussion on it. So Europe got that 50 basis point rate hike, and they're still sitting in the upper part of their day so far. Look at all these wicks across the bottom here. Talk about some defense. We're on a daily chart, and it continues to be defended along these lows. And it's still maintaining this run up from mid-December. It's weak, but it's above the 10, and it's testing near the top of this range like a RAID or an IX10. Asia closed weaker, still within yesterday's range and in the upper part of the range too. Although, that's not really saying much since the range wasn't all that awesome, but inside day closed in the upper portion of the inside day, not necessarily overly negative. Energy is going to be testing a lower trend line. We've got WTI on the left and Brent crude on the right. There's a lot of calls for continued weakness in energy and oil space. The numbers that came out yesterday were shocking. Supply and demand 101. So I can't disagree with the call on WTI and Brent, the continued weakness. Just keep in mind, it's not going to move downward in a straight line, right? We're going to see pullbacks, and we might see a few challenge plays. But if we can break this lowered trend line, then 70 is on the table. We just need to be cautious about finding a little bit of support here and rallying back up into resistance. And it's worth noting, although I don't really see that it fits, but this is a higher high and higher lows, at least so far. That higher high wasn't by very much. It's almost, non-existent. And the lower low can't be called yet, because we can only call that a lower low once it's turned and price has moved back up and it left that higher low pivot behind. When we're still in the drive to the downside, all we have is this higher low. So, it's worth mentioning. So we're looking at Brent down to 80 and WTI down to 75. And then we'll negotiate that trend line and see how it goes from there. If you want to play this without messing around in the futures, right? Because CL is $1,000 per point. That gets a little scary. You could trade USO, and there is a Brent ETFs. I always forget what their market symbol is because I don't trade the Brent ETF. I don't really like the liquidity in it. USO's got the liquidity, and it does its job for me good enough. But if you want to find that ETF, you could just hit Google, type in, Brent ETF. You ought to be able to find it. I think it's an Invesco product. Get her done. All right, so we do have additional auctions today. It's not as big as yesterday's auctions, the 10 and the 30. It's going to be the front end, like the IRX. But 11 and 11:30. So once we get past 11:30, econ wise, we're good to go. The only thing you'll have left to worry about is who's out there chipping their teeth. And I didn't see any Fed speakers in the US on that list today, but that doesn't mean that they're not going to get out there, right? They've been mute now for 10 days. I'm sure a lot of them want to get out into the public and kind of spread their cheese around. I think the only reason we're not seeing them on that list yet is they want to get the same book, so that when they all come out talking, they're all talking from the same data points. That's my take on it. So we do have our trend line breakover, and it's stuck. We're keeping it. Right now, the next trend line to worry about is the lower one. You could focus on an angled or a straight trend line like that, but I find those have less follow through, right? They're not as respected as much as an angled trend line. Still, there has been a significant amount of liquidity up there that we had to parse through before, and we did not manage to get through it. So it's very likely that liquidity resides on the other side of these, sitting right up in here. And that when we get in there, that's what we're going to have to negotiate, whether it's going to be today, tomorrow. We're going to get into it at some point, and that's what we have to resolve this week. If we don't get it done this week and we just pull back off of it, then the expectation is we'll tag that lower trend line, maybe give another run back up, try it again. We're still printing these higher highs, so nothing's changed on that end of things. When I was looking at things this morning, the image that came to mind was a rally up into failure. And it's still on deck for me this morning. It's exactly what I've got in mind, especially when I was looking at the Dow. But I think I'm going to be playing the NASDAQ today. Definitely has the most room to fall. If we start falling, I'm taking a ride on the NASDAQ. But what's on my mind this morning is a retest of yesterday's high and then a dump. It'll be a fake breakout fast failure play. We could overshoot yesterday's high easily, no problem. Get up into that white line around 41.75 and then fail. I just don't see this rally continuing. And, we don't have to assume that I'm right and try to go long here. What we're talking about is if we do rally back up and if we do break above yesterday's high, let it prove that it's actually breaking out. We're only up 0.5% this morning. We could easily run another 1%, no problem. So if I'm wrong and we break out and we continue to run, I haven't put on a short yet. So it doesn't matter that my analysis of a failure is wrong. We can just trade the long trade, right? Go long instead of short. But let it get there and prove it first. Volume is within our average and within our range around that 138 area. It's cumulative overnight volume. Once we see it, we realize we are where we need to be. We don't need it, so get rid of it. We have a missed daily pivot. That's an MDP to the upside. You can search for what that means. It's pretty easy to find. It's a pretty decent strategy. I don't trade it. I just use it in my analysis. ADR half matches up fairly close with the previous week's high because we are in an inside week breakout, right? We were inside. And now we have broken outside of the previous week. That's always a good thing, getting a higher high at the moment. If you use OCR analysis instead of just your plain old regular everyday technical analysis, OCR, one candle reversal style analysis, would focus on each individual open, high, low close in relation to trend, momentum, distance from previous close, all of that, instead of using like multiple candle style analysis. So with this, the expansion from last week and then the continuation so far of this week with higher highs and higher lows, this is a full-on trend in the micro space, right? Using OCR only. So we'll see. So far, so good. Day 30-minute volume profile. We should lose the bottom of this profile throughout the day today. There'll be a little bit on Friday that we'll still have to negotiate with, but by Monday, we will be looking at a volume profile with a low of around 39.60. So that'd be really nice. We'll have wiped out this last area here, and we'll be almost into a classic shape of a D. I say that, but today we're sitting up at this 41.47. We could start to grow some volume through here if we hold this range, and then we're going to end up with a B shape. B is in Bobby, right? Classic B instead of the classic D. Point of controls at 40.35, still a long ways off. When we're at the low of the box, we expect to go to the high of the box. And when we're at the high of the box, we expect to go to the low of the box. Just remember, by Monday, the low of the box won't be way down here. It'll be right there. And then we would just be looking at, a little bit of a gentle pullback before a continuation, or just staying in this zone of chop that we've been residing in. If we do manage to hold the highs for the rest of the week, kind of this, bear pennant or I assume a bull pennant or bull flag, however you want to say it, pennant or flag, they're both continuation patterns, whichever one you want to call it. What I would be looking for is the bull flag failure, which I don't normally play the bullish flag failure. I normally play the bear flag failure, but it's still the same thing. Every pattern leads into another pattern, right? And so if we were to game this out, a failed bull flag would turn into an inverse cup and handle. Isn't that really nice? Right. And then from there, you have your trend, and each one just leads into the next one. But it would need to fail first, right? Otherwise, we're going to look to measure this expansion and plot it up to the next expansion. No reason to do that yet, because, in one sense, we still have a gap here that needs to be filled. Technically, it's not a gap, right? We can see there's a candle there. It's not a wide open space. It's a liquidity gap, which we can see a lot better now that we're on the 5-day 5-minute, what we call mapping out the 5x5. When we traveled through this zone here, it was a very shallow zone. We didn't leave a lot of liquidity behind. And if we were to break back down through that, we would very likely move through it just as quickly to the downside as we went through it to the upside, because there's nothing there. We do have a VPOC now. We'll just borrow this one. Ain't need it. That would be 40.76. There is the anticipation that if we were to move that direction today and we get there, we'd at least have a first touch bounce. Think about where the volume profile was, the VPOC yesterday, and how when we came down into it, sure, we didn't stop on a dime, but that was during the violence of the FOMC. First, the data points came out, and then when Powell started talking, and that was the line in the sand, right? The previous day's point of control. We don't need that line anymore, though, because it's no longer a VPOC, so we take it off. But this one still sticks, so that's going to be our new one. For the upside, we do have one up there still, 42.30. It's been there for a while, kind of like an old friend by now. We just throw some shade at it every once in a while. And we have one to the downside still at 39.88. It's been there for a little bit. I'll come back to it. All right. Distance from the 10. We moved pretty good yesterday. We are 2% away from the 10-day moving average. That's not exactly the farthest we've been away from that, but it does start to get us into a little bit of a danger area. I don't have an average on here. Probably need to, but I don't have one. So, if we just kind of go back and look at how often we've been at this high before, and then how much farther we've been above that level before we saw a reversal, many times back in, November, in that July-August rally, we were expanding quite a bit beyond the 10-day, and we didn't just immediately reverse at 2%. But you can see how we're kind of getting into that area that says we've traveled just about as far as we would want to go before expecting a pause or a pullback or even a reversal back to the 10. This is kind of a gauge on, are we overbought? Are we overextended? Have we traveled too far, too fast? On the ES, we're not there, but we're getting into that area where it's starting to be a little bit of a concern. I wouldn't try to go long in short duration momentum plays to the upside until we back this off a little bit. Now, if you're, taking longer duration trades, looking at the 10-week, it's a little more concerning. We're kind of sitting in that spot that says we've traveled just about as far away from that 10 as we would want to get. And that it's a little bit of a concern. We've been higher than this, right? We've been farther away from the 10-week than we are right now. But usually within the next week, because think about every one of these bars, these histogram bars, represent a week. No, I misspoke. It's measuring on the week, but we're still on the daily chart. So it's how long in that week we stayed above it. Well, when we start to zoom in here a little bit, once we got above, say, 4%, we'll just adjust this line. Once we got 4% away from the 10-week moving average, within 2, maybe 3 days, we fell back in again. The only time that wasn't true was during that March recovery back in 2020 from the COVID lows, when everything just had this tsunami swell of buying coming in. All right, that was the only time that we extended for, week after week after week, or day after day after day above that 10-week, above the 4%. So we're there. When we're talking about, have we traveled too far, too fast? Have we overextended our run from the 10? Yes. We need to anticipate a pause here in the S&P. Within the next 2 days, and that makes perfect sense because Thursday and Friday, then we have the weekend. By Monday, we're expecting a pause. And that would make perfect sense. Kind of lines us up nice and neat. But between now and Friday afternoon, we could still continue to expand easily up to the 4,200 and even a bit beyond that. In technical analysis terms, we have not gotten above this previous high. So we're still looking for our higher high over here. And it would not surprise me if we get it, right? That's kind of the, and that might be all we get, but tagging that 4,200 before we get that pullback. Either way, the pullback is coming. We're starting to form a rising wedge that has broken out of the top. And that's something that surprised me the very first time I saw it, but after doing some research, it's no longer such a surprise because it kind of makes sense. When you have that rising wedge, that's a very poor rising wedge, but whatever. I'm not an artist. It's supposed to fall through the downside. That's what the rising wedge does. But every once in a while, sometimes you get that breakout to the upside first. And it's usually like this very large, very big expansion candle, like yesterday's. And it'll suck everybody in and get all the bulls convinced that we're headed to the moon, and everybody goes long, and then it flips over, dumps them on the head, breaks through the bottom, and down it goes. So it's this blow off top candle on a rising wedge breakout to the upside before fake breakout, fast failure, dumps back down and flips through the bottom of it. That's what we're on deck for right now. The NASDAQ is up 1.5% this morning. Looking at it on the daily, you can see the extent of the move is significant. This isn't even a wedge, right? It's just going and going. Let's take that over and put it into, distance from the 10. More than 7%. Take it back over the last 5 years, we've been higher than this, but it was during the 2020 COVID recovery, during that fire hose event. And other than that, when we've gotten into this level, we've paused, stopped, consolidated, turned around, went back the other direction. So this kind of confirms that in the S&P and in the NASDAQ, we're very likely to see a reversal next week, or at the very least, quit expanding next week. That will pause and let the market get caught up and heal a little bit. We are 4% away from the 10-day instead of the 10-week. And again, that isn't the highest we've ever been, but it's in that area that says anticipate a pause. It's worth noting that we already do have our higher high from this December high that we had. And that the current market movement here looks like a blow off top to me. We'll see. All right, structurally speaking, we want to use Thinkorswim's new quant tool. Mark the 50% of yesterday's level. $41.05.88. If we start drifting to the downside today, if we're going to keep this bullish move using an OCR analysis, it needs to stay above that 105. If we go below it, it needs to come back up and close above it on the day, right? So we can wick down below it, we can overshoot it a little bit, but on the day, it needs to close back above that level. That's our line in the sand that needs to be resolved, right? We got to keep it. All right, perhaps it's not very much of a surprise that a lot of things are up this morning and energy is down. We're seeing that capital rotation a little bit. The China ADRs, KWEB down, energy, XLE down, emerging markets, which is another representation of China, down. Building materials, oil and gas, oil services. And interesting enough, even TLT is down. Bonds were looking really good yesterday. But we have been stuck inside of this candle forever. And we're still negotiating with that. I was reading a Bloomberg article that talked about trillions of dollars waiting on the sidelines to get into bonds. And when that money starts coming in, it should be fairly obvious, right? It should be another fire hose event. So you can try to go long in this and, negotiate your way through it, or you could just wait for that flood to come in. I don't think it'll be hard to miss. But at the moment, we're still stuck inside of that green candle that I marked out. All of this has been IX10. The thing about an IX10, when it's this big of a candle, it's not really a representation of compression, right? If we have been stuck inside of, say, one of these three candles, and when we were, look at the breakout of those. That was a really nice IX10 follow through when we were stuck inside of that range, and then we finally broke out of it. Nice compression, and then a release of all that energy. Beautiful, great, awesome. But now, if we are going to bring it in that close, we're inside day, and we need to see bonds give an expansion on this inside day breakout, and then negotiate that big candle that I was just talking about. Now, we so far have been unable to get out of. So make or break. We're going to be watching this for a reversal. It's like I've said before, I don't know it's going to reverse there, but if it was going to reverse, this is where it would happen. I don't have to guess or assume. I'm not in the prediction business. Just let it reject and trade the fade, or let it break out and trade the breakout. So we've got a long ways to go. UNG continues to expand to the downside. Even this morning, we set new lows. It's trying to work its way back up. We do not have any confirmation signal, right? If you were to try to go long at these lows, you're doing it just on the idea that we've gone a long ways in one direction, and then we're kind of due for a move back the other direction. I put on a trade in this yesterday afternoon with some really cheap, far out of the money stuff. I've got like a 3-cent spread, right? Like if I'm wrong, I'm going to lose 3 pennies. Now I have more than one, but that's beside the point. The size of the spread is really small. So, you can negotiate a trade like this, even though we don't have any signal of a reversal yet, that it's going to begin going back up. When the trade risk is so small, you can throw $1 at it and see what happens. It's just like buying a lottery ticket. Otherwise, if you're looking to size up with conviction and kind of put on a larger trade, you got to wait. We need this to actually turn around and build a spread. It can go to zero. If you look at oil during the 2020 COVID situation, they had all this supply that they couldn't do anything with, because remember, we shut everything down, and they were actually pouring that crude into old caves and abandoned caverns, and you know what I mean? Like they had nowhere to go with it, and oil went below zero, which really screws up the whole technical analysis charts when you see a chart that actually went, below zero. So technically this could go to zero, but I don't think it would, right? And if you think about the cost of nat gas right now on the eastern seaboard of the United States, some people are paying nearly 75% more than they paid a year ago or 2 years ago for gas. So I don't see it going to zero, but could it go there? Yes, it absolutely could. Technically, it could. So if you're one of those people looking to play the long on this, a little bit of patience. Look back at 2020, right? Look at how it based down here for a while before it finally started working its way back out. Even in the 2021, it was a smaller base, took less time, but still it wasn't some V bottom reversal, right? And that's kind of the same thing here. Very often you'll see a V top reversal and you'll see a bottom building a base before it reverses. We do get V bottoms, right? Just like right there. It was a minor V bottom though. More often than not, we're going to build some structure first and then turn around. If you look at the classic Wyckoff style charts, right? The like old school Dow stuff, it's the accumulation distribution charts. So a little bit of Guns and Roses, just need some patience. I continue to use that 104.3 New York radio station. Those guys are absolutely amazing. If you're looking for a radio station, that's the one. Q1043. All right, we got more on the buy side flow than on the sell side, but it's still pretty light at the moment. Look at what's down this morning. Healthcare, consumer services, or consumer discretionary, materials, industrials, what we consider defensive names and defensive space. Consumer discretionary, which is one of the 3 risk-on sectors. There's a lot of those that are in the green this morning. All right, so we're looking at how many names in the NASDAQ are up at least 0.5%, 27. Not really inspiring for a bullish run this morning. That's not very much. For the S&P, 22% of the S&P is up at least 0.5%. And again, not inspiring at all. That's barely bullish. So that really needs to change. Looks like we're getting another run in the S&P back up to the Globex high. Just continue to keep in mind the expectation is a breakout failure if we even manage to actually get the breakout at all. But a retest of yesterday's high, maybe a little overshoot and then a dump. And so far, none of this is causing me to reconsider. Names in the NASDAQ that are up at least 1% this morning includes Meta, which had earnings yesterday, which I was going to take a trade in that, but I never got a chance to parse out how the earnings went in one of those sister companies that had reported before that. And without getting that done, I just didn't feel comfortable putting a trade on in Meta. Should have, it would have worked out really good, but either way, coulda, woulda, shoulda. It's the FANG names. So Google, Facebook, Tesla, Apple, and then we've got a few ancillaries, right? Even Zoom is doing good, which I'd seen a few articles on Zoom suggesting perhaps a little bit of recovery in this, like we have started to see in Netflix, Facebook, and a couple of others that had really taken a beat down. This certainly got ahead of its skis during that whole 2020 situation. So it kind of reset itself, got back down where it belonged. And now analysts are talking about how, now that it's back to its normal range and it got rid of, that flawed expansion, that we could start to see this turnaround. It's not on the 2023 contrarian list yet, but I wouldn't be surprised if it gets added to the list. And in the S&P, 12 names are up more than 1% this morning. And it's the FANGs again: Apple, Tesla, Amazon, Google, Facebook. It's not every single one of those FANG names, but it's close. The size of the box here shows us their market cap in relation to others in the same space. And the monsters of tech stand out: Tesla, Amazon, Google, Meta, Microsoft, Apple, NVIDIA. These are some big expansions. So we really start to see that capital rotation, energy and materials, communications, manufacturing, healthcare, consumer, like food, and not looking too good, right? Even healthcare, not all that hot. Couple names that we could see in there that are okay, but just so the capital rotation is really kind of front and center. Finance is really weak. We're going to see this come back around. I mean, technically it's possible for, Tesla to get back to 200. It's not that far away at this point. But this thing is still in a solid downtrend, and that's not done yet. If we were to use, say, high to low on our fib, the current week isn't done yet. Technically speaking, I don't like to see it get past that 786 and close above it, and we have. So that's my line in the sand. If we were looking for a reversal, it would have to get above that and hold it. And so far, that's what we've got. So we could expect a continuation at some point, but 50% is still the line in the sand on the big picture. If you go and read the books, old school would have us looking at, the 618, which I don't use. And since I keep my analysis consistent, I don't use it. Sometimes I just don't use it, right? If you're not going to use it, don't use it. I'm only mentioning it because if you don't do it in a self-adjusted way, if you're just doing it by the book, then this downtrend is still intact because it has not pulled back more than 618. On a day-to-day basis, tech can do it by itself. Absolutely. We need at least 2 risk-on sectors, and usually that's consumer discretionary and one of the others, consumer discretionary and finance, or consumer discretionary and tech, one of those 2. So it could do it. If we're just talking about a day trade, no problem. But if we're talking about, a sustained market rally, we kind of have to have all of the boats rising, right? Otherwise, financials are strong enough by themselves to hold the S&P back. If you look at KRE yesterday, and you look at the NY Fang yesterday, which is our representation of mega market cap tech stocks, they both had that nice rally back up, but finance certainly pulled back more than tech did going into the close. And if you look at the advancing versus the declining issues, this doesn't quite say that it was finance that did the pullback, but the NASDAQ closed really high on the day with a solid advanced decline, while the S&P really gave a lot of it back. And you got to kind of figure, what was it? What was those names in the S&P that were giving such a pullback? And obviously, they're not the same names that were in the NASDAQ. Well, the big difference between the NASDAQ and the S&P is that the NASDAQ 100 does not have financials. So this pullback very likely was because of the financials, because there's no financials here, no pullback. Now, I'm making assumptions there, right? And we can prove that I'm right or wrong. All we have to do is spend more time digging, which we're not going to do. I'm okay being wrong. I've been wrong before. We're just making an off-the-cuff assumption. So if we're going to look at a bullish day today, we want to see tech and finance. Now, what we've been seeing in the last 3 months is an either or, not a both, right? If we have tech versus finance, which is what we've seen in the last 6 to 8 weeks, instead of tech and finance, then it's going to be a choppy grind. We could still go higher, but it'll be choppy. It'll be a fight, right? We want, at the very least, to see one go flat and neutral and let the other one run, as opposed to actually having to pick and choose between the two, which would be more of that fight. Keep in mind that Apple still is a threat. I haven't seen a lot of expectations that this is going to miss, but when Apple reports, it won't just be the numbers from the company. This CEO, when he comes out and talk, he has the weight behind his words. Not like Powell. I mean, he's not that big, but what he says is really going to be taken by the market. And so if they start saying a bunch of negative things about their outlook on, the economy, their outlook on business going forward, consumer spending, all of that's really going to be taken into consideration by the market over the next few days. So Apple alone in this report has the power to really knock this market to its knees or pop us up higher into a whole new leg up in the S&P. So a really big deal. And again, it won't be just the numbers, right? It won't be like, oh, Apple hit or Apple missed, top line, bottom line. It's going to be more of, what did Homeboy say when he came out during that announcement? Because it's going to be taken and parsed out very closely. So this is the next threat on the table. There's a few players out there that have the weight behind their words to really move the market. So just something to keep in mind, right? It wouldn't even be a bad idea to consider some YOLO plays on this, just like we considered them yesterday in Meta. And I really wish I had just put my trade on, but I was uncomfortable. I had failed to accomplish something that I wanted to do yesterday before I took the trade. And since I didn't get that done, I just didn't put my trade on. But oh boy, that would have worked out really good. If you remember the target levels that we were looking at, they're still on my chart, right? All those lines that we drew yesterday. We were talking about putting spreads on between 170 and 180 and between 135 and 125. And those lines are still there. And if we look at where we made it, we were all the way through it on the other side. If you got that butterfly that we were talking about yesterday, the expectation is that this is going to pull back a little bit in the next day or two. That butterfly might be a really good butterfly. And for a vertical, I mean, you did really good if you took that upside vertical. We were looking at cheap stuff, which now has expanded beautifully, perfectly. So something to consider with Apple today would be the same thing. At the moment, we've got 2.5% ADR, and I'm going to round up a little, 3.5% for the market maker move. So we're looking at 6% move today. Before they even report, we could see a 6% move today. If we come in and look at the measured move from the implied volatility average, it's $5.50 and then $5. So you're looking at, 10.5. I'd just round up and say $11. Everybody, be careful, be safe. Remember, we're looking for a fake out this morning. If I'm wrong, you could measure the range of the Globex to the high of yesterday's close and then plot that out for your upside projections. if we don't dump, right, we actually break out and expand, use that quant tool that Thinkorswim recently added, snap it from the high of yesterday to the Globex low, and that will give you your upside targets. 50% of that is 41.76, and 100% of that move is 41.90. Now, technically, you could just bring it in and use only the Globex. There's nothing wrong with that, and the numbers aren't really that far off from using the high of yesterday. Either one would be fine, right? And then for the Fibonacci, a 1, 2, 3, 6 tag, which would be the next leg up, would be 41.70, and then we would expect a drift or a draw back to 41.66 before the next leg up, right? And then we would just keep running our fibs up and up and up from there. Everybody be careful, be safe. Have a good day. I'll see you all tomorrow.